All right, let's get right into it. Today, we're going to be talking about the investment risk ladder and the different things that you can invest in and the risks associated with those different things. Let's go. Cash necessarily isn't an investment, but it's what you use to invest into all these different things. And cash can be used for example, at the lowest levels, savings accounts, money market funds, where you can just accumulate small percentage interest that different accounts will give you, different banking institutions will give you for the whole year. 4% for the whole year, 4 point something, 3%, 5% for the whole year, and you could just let your money grow like that. This is deemed to be the safest investment because there is no risk of losing. Your money is FDIC insured, so your money is just staying with the bank account, securing interest with the bank institution itself. All right, let's get right into bonds. The risk level associated with bonds are low to moderate, and you can describe bonds by being loans made to governments or corporations, and they pay interest over time. The risk that is associated with the bond is the person, the corporation that's lending it, the issuer, it's their credit worthiness. So that's why the government bonds, like the US Treasuries, are very safe because it's from the actual government itself. While opposed on the other side, corporations or high yield bonds carry much more risk because they're from an actual corporation themselves. Is not necessarily insured as it would be from the government. And the high yields, depending on what they are, usually are quick cash grabs and never are good for long term. The return for bonds is usually fixed return from interest payments with moderate growth potential. The risk of the loss is if the issuer itself defaults or if the interest rates rise. This is where risk starts to get higher and higher as we get into the mutual funds. The risk level of the mutual funds could be associated with moderate to high, depending on which mutual fund you choose. And a mutual fund is basically mutual funds. They collect a whole bunch of money from multiple investors to then buy a set, diverse portfolio of stocks, bonds, or other different asset securities that they choose. And the risk depends on the fund's asset mix, what they choose in that bundle, in that basket, what they decide is the risk associated with the investment itself. And these investments are diversified where there's a whole bunch of different companies, bonds, different types of different things in one set individual investment. It's not your money spread out throughout all these different things. It's your money in this one thing that complies of all those in one thing. So it's a very diverse and good thing depending on which mutual fund you get. And now let's get into the next thing that's very similar to mutual funds, but is altered from time to time because they're controlled by fund managers, by the investors at these organizations that are making the baskets and then adjusting them from time to time depending on the circumstances in the market, or maybe a particular company is not doing as good and another one needs, and then they'll replace it. And that can be good and bad depending on the same time because there's more fees associated with these, and just as the mutual funds, maybe the basket is incorrect, and with the fees alone, the compounding over time would then change, and it sets a whole different level and it changes your returns. So let's get into the description of ETFs, exchange traded funds. ETFs are similar to mutual funds, but trade on an exchange like stocks. ETFs can track various assets classes like stocks, bonds, or commodities. Just like the mutual fund, the risk varies based on what the ETF holds. Some ETFs can be low risk, like bond ETFs, while others, like sector specific or leveraged ETFs, can be high risk. ETFs can provide broad market exposure with diversified risk, but returns vary based on underlying assets, just as the mutual fund. Depending on the mixture of the basket itself, the fund will be the return and associated with the fees, because there's usually more fees associated with ETFs than mutual funds. But let's get into the main one, everyone's favorite, my favorite, individual stocks. When you're personally having ownership in an individual company of your choosing, which carries the most risk out of all of these options. Let's get right into it. Risk level is high. Simple. Description: stocks represent ownership in a company, and their value can fluctuate significantly based on a company's performance and market conditions. Stocks carry the highest risk among all these assets, especially individual stocks, which can be highly volatile. You never know what's going to happen in a company. Absolutely anything can happen. Tomorrow, it can be found in the news that they were lying about all their finances and sheets, and the whole company could go under. You never know what's going to happen with any company, with any individual company. But that's not to say that you can't make money with stocks. And if you do your due diligence, and if you always have the long-term mindset, all you have to do is keep it simple. Don't FOMO into hot stocks. Do research, understand what you're buying, invest into things you know, and this can be the worthwhile return for you. But it's definitely the riskiest. And it's about having a mixture of everything, diversifying your entire portfolio to then have all of these things to then soften the blow if anything doesn't do good. Having a combination of cash, bonds, mutual funds, ETFs, stocks, and such other investments can really help your overall portfolio over your lifespan, keeping it safe, helping your returns, and just not losing money, which is the most important thing. I hope you enjoy. I hope you do your research. Invest. Good luck on your journey. Have a great day. Get money. Let's do it. Let's get it.